Podcast Network Asia. FirstMetroSec is providing this podcast as a general market commentary. Reference to any specific security, product, or entity do not constitute as an offer or a solicitation of an offer to buy or sell any financial instruments or to participate in any particular trading strategy. The statements, comments, views, or opinions expressed by the hosts are subject to change without notice, and FirstMetroSec is under no obligation to update, amend, change, or correct any of the statements, comments, views, or opinions expressed. The statements, comments, views, and opinions expressed by the guests are their own and do not necessarily reflect the view of FirstMetroSec. FirstMetroSec disclaims any liability arising from reliance on or reference to any information obtained in this podcast.
You are listening to First Metro Securities Philippine Stock Market Weekly podcast, where we feature timely and relevant discussions on the Philippine stock market and the economy, in the hope of providing you investing and trading guidance. Here's your host.
Hi investors and happy holidays! It's Anjz from First Metro Securities and you're tuned in to Market Bites. If you're on the hunt for fresh trading ideas or simply want to know which stocks deserve a closer look, you've come to the right place. Today, we'll be diving into the key highlights from our latest update on Ayala Land Inc. or ALI. We are keeping our buy rating on ALI, but we've trimmed our target price to 28 pesos as we shift our valuation base to next year and adjust estimates to reflect adjustments in management guidance. Management has taken a more cautious view of growth for 2025, so we've adjusted our numbers to match. Even with that, we still see ALI delivering about 8.6% earnings CAGR between 2026 and 2027. The big driver here is a shift toward leasing and recurring income. Think malls, offices, and hotels, rather than relying mainly on property sales. Despite the downgrade, ALI remains one of our top picks for 2026. It's a large cap cyclical name positioned to benefit from an economic recovery and potential foreign fund inflows. And with residential sales still facing headwinds, ALI's pivot toward recurring income streams gives investors more earnings visibility and cash flow stability. Let's break down Ayala Land's latest results. For the first 9 months of 2025, ALI posted 21.4 billion pesos in net income, up just 0.9% year-on-year, below consensus in our estimates. Property development revenues held steady at 75.9 billion pesos, while leasing and hospitality grew 6%, helping offset weakness in premium residential sales and slower construction activity. By segment, on the residential side, reservation sales rose 3% to 111.7 billion pesos, showing resilience in core housing and demand for commercial lots. But premium projects struggled with slower take-up across new launches. Interestingly, vertical projects in Metro Manila gained traction, supported by strong absorption of ready-for-occupancy units. Leasing and hospitality were the bright spots. Shopping centers grew 7% year-on-year thanks to new malls and high rents. Flagship projects like Trinoma and Ayala Center Cebu are set to drive a 15 to 20% rent uplift once fully operational in 2026. Hotels also benefited from higher room rates and the acquisition of New World Hotel, signaling a strong recovery in pricing. The office segment stayed defensive, with occupancy at 90%, well above industry norms. Importantly, ALI is shifting more capital toward leasing assets, with malls and offices in the pipeline to support recurring income growth. Management has moderated its growth outlook for 2025, now aiming to simply outpace GDP rather than double it. CapEx has been trimmed to 85 to 90 billion pesos, and property launches scaled back. But sales target remain intact at 135 to 145 billion pesos, with 77% already achieved. To have a more positive outlook on the stock, we would like to see the following. First, we'd like to see stronger pre-sales that pave the way for more aggressive project launches. Second, a clear reduction in residential inventory and office vacancies, especially in Metro Manila. And third, a meaningful boost in leasing revenues once renovated malls start contributing. Of course, there are risks to take into account. Macroeconomic headwinds could weigh on property demand and retail spending. A slower pace of launches might cap near-term growth if inventory takes longer to clear. And finally, there's execution risk. Delays in mall renovations or office completions could hold back the leasing-led pivot. So, to recap, that's a buy, call, and alley with a target price of 28 pesos. Yeah, and that's it for this episode. Thank you for listening to Market Bites. If you found this helpful, make sure to follow First Metro Securities on Facebook, Instagram, and YouTube, and check us out on TikTok at FirstMetroSec for more market updates. That's it for today. Catch you in the next episodes.
Thanks for listening to First Metro Securities Philippine Stock Market Weekly podcast. Don't forget to follow us to get first dibs on our new episodes. For more up-to-date market news and info, exclusive content, and the opportunity to connect with your fellow Filipino investors and traders, join facebook.com/groups/FirstMetroSec and be part of the First MetroSec family.
The views and opinions expressed by the podcast creators, hosts, and guests do not necessarily reflect the official policy and position of Podcast Network Asia, the hosts of the program, or other programs of the network. Any content provided by the people on the podcast are of their own opinion and are not intended to malign any religion, ethnic group, club, organization, company, individual, or anyone or anything.